welcome again. And as we get started, welcome to those of you who are just entering into the room. I'm going to get started with a few housekeeping rules as we wait for our guests to continue joining the call. This is myself, Anthea Pilo, Policy Specialist here at AFI. And as you know, the usual drill, we welcome you to be engaged, to share your information, to share any questions, any feedback. Please feel free to make use of the chat function at the bottom. We've tried to keep the session short and sweet such that we can give you more time to spend on your other duties, but would still appreciate the engagement from all of you. If you have any questions, please type them in the Q&A session, and please raise your hand if you do want to raise a question and speak to it specifically. We also encourage you to keep your phones muted. And there's a caption, there's an opportunity to get multilingual communication. Please just click on the caption icon at the bottom and be able to choose the language that is that you'd most be comfortable listening to. I'm just going to briefly take you through the agenda. This is the first few minutes where we're giving an introduction and welcoming you to the meeting. And then shortly after, we'll have a technical session from Beatrice. And then we'll get into a discussion from where one of our head of policy is going to be able to facilitate a discussion with our presenter. And then we'll have a few minutes to close off and get an evaluation from all of you. In the meantime, I'm going to just, if you don't mind, I'm going to stop sharing and I'm going to ask you to please turn on your camera such that we can take a quick photo and then we can get started. If you could all turn on your cameras from wherever you are.
Sorry, and can you please stop sharing so we have all the screens?
Sure. Okay. Are all the screens visible?
You are on mute, Susanna. Count again.
Talking to myself. Okay. Thank you, Ante. 1, 2, 3, everyone, please smile. So we just managed to take a picture of the first page. Let me click on the next one. One, two, three, smile, please. Just one more. 1, 2, 3, smile. Perfect. Thank you very much. Over to you, Ante.
All right. Thank you so much. Thank you, everyone, for joining. I'm going to get us started because we have a few minutes to start. I'm very pleased to be able to introduce to you our speakers. She's a friend of the Competition Knowledge Enablers Exchange. For those of you who may not be aware, AFI started a Competition Knowledge Enablers Exchange workstream in which we try to understand and share knowledge on competition and how it impacts on our roles as regulators in this space. Just going to briefly read her profile before I invite her to speak to the slides that I'll share. So Beatrice is a competition expert at the OECD Competition Division, where she leads policy and capacity building initiatives, especially within financial services. Her recent work focuses on the intersection of competition in mobile payments and the balance between prudential regulation and banking market dynamics. She served previously as the Assistant Attorney General, the New York State Attorney General's Antitrust Bureau, leading high-profile cases across digital platforms, healthcare, and energy. She's an award-winning lawyer with an LLB from the University of Bristol and an LLM in European law. Beatrice, I want to welcome you and thank you so much for taking the time to participate and to share with us some of your knowledge. The topic you're tackling is quite critical. We've all been thinking about how to balance regulation and how to balance regulation in the competition space as well as our prudential experiences or our prudential requirements as per the law. Please help me welcome Beatrice. Thank you so much.
Thank you very much, dear Antia, and thank you very much to the Alliance for Financial Inclusion for this kind invitation and for allowing me to join you today to discuss this important topic, which is increasingly relevant for contemporary financial policy making. And it's very much how to balance prudential regulation with competition considerations in banking. So good morning, good afternoon, and good evening, everyone. Maybe if we could move to the first slide, please. Thank you. So, as you know, traditionally, the mandate of central banks and prudential supervisors has been centered on safeguarding financial stability. So this means ensuring the financial system continues to safeguard deposits, to intermediate savings into productive investment, and provide essential payment and credit services even during periods of stress. So capital adequacy, liquidity, and supervision have generally been the dominant concerns for supervisors. However, the financial system is evolving rapidly. We see how digitization is transforming delivery channels. We see fintech and big tech amongst many other new entrants into retail financial services. And this means that there are new opportunities and new risks, and supervisors are increasingly tasked with addressing them. So as a result, the role of competition in financial services is gaining increasing attention. And before diving into the substance, I would like to start by setting the stage with a couple of key competition concepts. So when we speak about competition, we mean the process by which firms seek to attract customers away from their rivals, and they can do so by offering better prices, better quality, or innovations. And closely related is the concept of market structure. This means the composition of a market. So it could include the number of firms in a market, the relative size of each of those firms, and generally the degree of concentration in a market. Market structure can matter because it shapes competition incentives. So those incentives to offer better price, quality, or innovation, and it can also shape the risk-taking behavior of firms and thus impact long-term resilience. Another key concept is contestability. Contestability refers to the extent to which new firms can enter and scale or grow within a market, and the extent to which customers can switch providers. So this allows the exertion of competitive pressure on incumbents, which again leads to better prices, quality, and innovation for consumers. And a market may have only, say, a few banks or non-bank financial companies, but still be contestable if the market has low barriers to entry, or those barriers to entry are proportionate, if the switching costs for consumers are low, and where incumbents, by which I mean the dominant or largest service providers, face or feel that credible competitive pressure, which then incentivizes them, again, to offer better prices, quality, and innovation. So by contrast, even a market with many players may lack contestability. And that is where, for example, say regulation or other structural barriers to entry, such as network effects or data advantages, prevent that effective entry and expansion. So competition objectives may sometimes appear to sit in tension with prudential objectives, and indeed at times trade-offs will be required. However, stability and competition are not inherently opposed. When frameworks are carefully designed and calibrated, they can reinforce one another. So the way that we design regulation today can shape market structure, contestability, and systemic resilience for decades to come. Next slide, please. So this afternoon, or morning or evening, I will focus on 5 themes. First, I'd like to address where the tensions arise between competition policy and prudential regulation. And then I'd like to address some key complementarities, including, for example, the importance of credible market exit and merger control. Third, I will address a couple areas where that balancing between prudential regulation and competition objectives might be particularly challenging, such as capital calibration and authorization and licensing regimes. Fourth, I'll discuss a couple policy responses that we see across jurisdictions, including adoption of proportionality, simplification, and graduated licensing frameworks, for example. And lastly, I'll conclude by addressing some frameworks for enhanced cooperation among competition authorities and financial supervisors, and also the use of systemic considerations of competition in regulatory design. Next slide, please. And I'll just note that all of the discussion today and what I'm presenting is very much based on that OECD recent work that Antea kindly flagged to you, which is a background note on balancing prudential regulation of competition in banking. And it also draws from a couple other recent works by the OECD Competition Committee on financial services with a particular focus on retail banking. So let me begin by a quick overview of the objectives of prudential regulation and competition policy. So as all of you know, banks perform essential economic functions. They safeguard household savings, they allocate credit to productive investment, they facilitate payments that underpin the real economy. However, these same functions expose banks to structural vulnerabilities: liquidity risk, maturity transformation risk, asymmetric information, and risks of contagion. And prudential regulation exists to mitigate these risks. So licensing regimes, capital and liquidity standards, and supervisory oversight are designed to reduce that probability of institutional failure and also reduce the potential severity so that depositors can maintain confidence and markets can continue on fueling the real economy. Competition policy pursues a distinct but complementary objective. It seeks to ensure that markets remain open and contestable, that rivalry disciplines incumbents, that prices and quality reflect competitive pressure, and that innovation flourishes. So these objectives are not necessarily in conflict, but they do interact in ways that might require careful calibration. So the question is not whether prudential safeguards are necessary. They unquestionably are. The question is how they might be designed with competition in mind, given that they can shape market structure and incentives over time. Next slide, please. So let me turn to where some policy tensions arise most visibly. So from a competition perspective, contestability is central. Even the threat of entry can act as competitive pressure. From a prudential perspective, however, lowering entry barriers too aggressively might increase the risk if entrants are insufficiently capitalized or inadequately supervised. So minimum capital thresholds, governance requirements, and activity restrictions are therefore necessary. But if safeguards are not proportionate, meaning calibrated to the size, complexity, and risk profile of institutions, they might create unintended competitive distortions. And a second tension concerns innovation. Generally, competition authorities often view innovation as a driver of productivity and consumer welfare, while prudential authorities, on the other hand, might approach financial innovation more cautiously. Indeed, financial history demonstrates that certain innovations of the past amplified instability. A third tension arises during crisis. Emergency mergers or state support might stabilize markets in the short term. However, crisis-driven consolidation, by which I mean mergers, can entrench dominant institutions and reinforce too big to fail dynamics, meaning institutions whose failure authorities are unwilling to allow because of the systemic consequences. In the UK, the Lloyds HBOS merger is a historical example. Here, after the 2008 financial crisis, the government suspended normal merger enforcement in order to allow the transaction to proceed. However, later government officials reflected that the merger did indeed pose clear risks to competition, found that the market was very concentrated thereafter, because of lesser competition, customers ultimately were receiving offers that the prices weren't as competitive and the quality was not as competitive. Generally, they also found that other alternatives might have been more pro-competitive than allowing the merger. Thus, they found that it was a mistake to waive normal merger enforcement. More recently, we also have another example from Switzerland, where the UBS Credit Suisse merger was also allowed, suspending normal merger enforcement. And the concerns are about long-term concentration and systemic risks. The key concern here is that while such interventions and the suspension of merger enforcement might secure stability in the short term, in addition to substantially lessening competition in the future, whenever larger institutions become the default rescuers, the next crisis might require rescuing those rescuers. So without credible resolution mechanisms, authorities might face repeated intervention cycles that weaken long-term competition and also push systemic risks into the future. Next slide, please. So allow me to turn now to some of the complementarities. Competition can enhance resilience. Rivalry can encourage better, more efficient institutions, stronger governance, and better risk management. So a diversified banking landscape can reduce the reliance on a small number of systemically important institutions and also mitigate this concentration and systemic risks in the long term. So one of the clearest complementarities concerns credible exit. And by credible exit, I mean resolution frameworks that allow failing institutions to leave the market in an orderly manner. So this means without systemic disruptions, without recourse to public funds, and without creating expectations of future bailouts. So from a prudential perspective, failing institutions must exit in an orderly manner that protects depositors and limit contagion. From a competition perspective, inefficient institutions should not remain artificially protected. Contestability requires both credible entry and credible exit. So resolution frameworks serve both of these objectives. And importantly, while resolution regimes can be organized in different ways and do indeed take different forms across jurisdictions, the Financial Stability Board's key attributes provide certain international standards that support effective implementation. And just to give you a couple examples, living wills or recovery and resolution plans, these are, for example, used in the EU and US currently. They require institutions to demonstrate how they can be resolved without systemic disruption. In this sense, they are forward-looking when an institution is established. A related key innovation has also been the introduction of bail-in tools. So here, unlike bailouts that rely on public funds, bail-ins allow resolution authorities to impose requirements upfront. So by reducing implicit state guarantees, resolution regimes generally strengthen competitive neutrality. And what I mean by competitive neutrality is that a level playing field is kept, which enables competition on the merits. And this is where institutions do not benefit from public support, that distorts competition, or that they don't receive any certain advantages over other certain market participants that are similarly placed. And similarly, effective merger control prevents excessive concentration and limits the creation of institutions that are too large or too complex to resolve. So in this sense, both merger enforcement and resolution regimes are complementary tools. And close cooperation between prudential and competition authorities in both these areas is particularly beneficial. Next slide, please. So allow me to turn now to some calibration challenges. First, capital requirements are essential for absorbing losses and maintaining confidence, but they also function as a price tag for entry and expansion. So if they're set too high or applied without regard to the risk profile or complexity of firms, they may impose disproportionate requirements or burdens, particularly on smaller firms or newer entrants. So the Basel standards, which as you know are applicable for internationally active institutions, aim to harmonize prudential requirements and reduce regulatory arbitrage across jurisdictions. They also aim to support competition through a level playing field. So meaning that institutions facing similar risks are subject to comparable requirements. However, differences in adoption and implementation can have competition implications, where jurisdictions adopt Basel standards at different paces or through divergent rulebooks. Fragmentation can increase compliance costs for cross-border entrants and reduce competitive pressure. At the same time, however, applying the same rules to all providers without regard to their size or risk profile can enhance consistency, but it can also raise compliance costs for smaller, domestically focused institutions. So for this reason, we see that many jurisdictions apply proportionality principles, which are in line with Basel. Some, for example, apply the full Basel regime only to larger or systemically important banks, while others exempt smaller institutions from selected provisions or adapt simplified ratios. And these choices are not neutral from a competition perspective. Thresholds, exemptions, and simplification can influence entry incentives, growth dynamics, and business models. And here, Tunisia illustrates how calibration matters in practice. An OECD market study and competition assessment on the retail banking sector, which was commissioned by the government of Tunisia, found that minimum capital requirements across the sector were significantly higher than comparable international benchmarks. So just to give you an example, in Tunisia, the licensing process for payment service providers was identified as creating potentially unnecessary barriers to entry by imposing capital requirements that were from 12 to 76 times higher than those similar providers in the European Union. So while prudential robustness is essential, elevated thresholds may have reduced incentives to enter and reinforce concentration across the market. And Australia and New Zealand illustrate another dimension of capital requirements. In both these jurisdictions, the competition authorities undertook market studies of the retail banking sector, and they found that the way that advanced internal models and standardized approaches were being used advantaged the large banks, which managed to rely on advanced internal models for capital calculations, while in turn the standardized approaches affected smaller banking providers as well as non-bank financial companies, which then limited the ability of these smaller providers to invest and scale. So authorities since these market studies have narrowed these capital differentials to improve that competitive neutrality while maintaining resilience. And it's interesting to note that in New Zealand, additional reviews of the capital requirements are ongoing. So it'll be quite interesting to see what other adaptations take place since the central bank is coordinating very closely with the competition authority. Next slide, please. So I'd like to now turn to digitization and how this is transforming retail banking. So we see that many new entry occurs across jurisdictions through partnerships between banks and non-bank financial companies. So this includes fintechs and big techs, and this means that they're entering via these partnerships as opposed to independent authorization or licenses. And namely, this is through white labeling models, which allow, for example, fintechs or big techs to be the interface with customers, while licensed banks provide the regulated and financial infrastructure. So these arrangements may generate efficiencies. However, they also have the risk of entrenching incumbents, particularly where new challengers, new entrants remain structurally dependent on the very players that they're seeking to compete against. So this poses concerns from both a competition and prudential perspective. From a competition perspective, partnerships may weaken direct rivalry, they blunt competitive pressure, and they may also enable anti-competitive conduct such as tying or bundling or other exclusionary strategies. And from a prudential perspective, they blur the regulatory boundaries, that is the prudential perimeter, and they complicate supervision. So when crafting the prudential perimeter, it might be worth keeping in mind whether overly burdensome or complex regulatory requirements may unintentionally steer new entrants toward these dependency through partnership models as opposed to independent competition. Next slide, please. So where competition is weak, calibrated pathways to scale might be a way to stimulate entry. And here, let me tell you about an example from Mexico. So Mexico has popular financial societies licenses. They are known as SOFIPO. And this is authorization and licensing that allows providers to scale progressively. So generally, non-bank lenders can operate without any sort of license or authorization, and the same is true for payment providers in Mexico. However, when these non-bank financial companies might wish to eventually mobilize deposits, then they can obtain the SOFIPO license, which brings them under supervision and includes certain requirements, such as, for example, being part of a deposit guarantee scheme. So as institutions scale, they can obtain the SOFIPO license, and eventually then they could even move on to a full banking license, which has additional requirements than a SOFIPO license. And in Mexico, we indeed have seen many new entrants kind of adapt through this scale pathway. We have what I call success stories from Nubank, as well as a couple other local fintechs, such as Story and Clar, which started in Mexico by offering either payments or credit without the need of authorization or licensing. Eventually, they scaled and applied for SOFIPO licenses, allowing them to provide deposits to customers. And now all of these players have become full service banks with an omnibus banking license. And competition has been identified as increasing in the market thanks to this scaled pathway to direct rivalry with the existing banks. And we see not the same, but similar models across a couple other jurisdictions. In Brazil, for example, authorization and licensing segmentation frameworks differentiate the supervisory intensity according to the size and complexity of the participants. And India, for example, has a 4-level scaled framework, which again aligns prudential obligations with risk profiles. A different example comes from Hong Kong, where they have adopted digital-only banking licenses. And here, digital-only banking licenses apply a risk-based, technology-neutral approach tailored to virtual banks and their business models. So it focuses on governance and oversight rather than, say, certain physical presence requirements. And there was a recent review in 2024 by the Monetary Authority in Hong Kong, which concluded that the development of these virtual banking licenses positively affected competition across the entire banking sector. So they're seeing incumbent banks responding to this new competitive pressure from digital-only new entrants. So these frameworks exemplify how scaled authorization and licensing or digital-only licensing can create entry and scaling pathways thus increasing competition while at the same time preserving stability. Next slide, please. And simplification and proportionality can be equally important. We see a couple jurisdictions adopting new approaches to simplification. And here, for example, the United Kingdom has a new strong and simple framework, which aims to simplify prudential requirements, namely for smaller domestic deposit takers. So it streamlines capital calculations and reporting requirements while retaining robust safeguards. So the objective here is not deregulation, but it does aim to remove unnecessary complexity that does not materially enhance stability. And we see a similar approach in the European Union, where the European Central Bank has created a task force on simplification. And it's seeking to reduce supervisory burdens and also eliminate duplication. So the 2025 simplification agenda emphasizes focusing supervisory resources on material risks. And this risk-based simplification is seeking to preserve prudential robustness while enabling more contestability. So the idea generally is that complexity itself can function as a barrier to entry and expansion, and thus might be something worth thinking about when crafting or revising regulations. Next slide, please. So finally, cooperation and the systemic consideration of competition are essential. And as financial services are becoming increasingly cross-border, we shouldn't lose sight of the benefits of international coordination, as it can support consistent approaches. And importantly, at the domestic level, we see cooperation between prudential and competition authorities as helping ensure that measures designed to protect stability do not unnecessarily restrict competition. So regular dialogue, joint initiatives such as sandboxes, market monitoring, and forward-looking assessments can provide opportunities to identify emerging risks, areas where trade-offs might have to take place, as well as complementarities. And we see a couple examples across jurisdictions. For example, in Spain, following a market study by the Competition Authority, the creation of a regulatory sandbox was advocated and has recently been implemented. So this sandbox allows for innovative products to be tested within supervisory boundaries, while competition implications are considered in parallel by both the financial supervisors and the Competition Authority. In Israel, we see a different approach where an interministerial committee has been created with the purpose of increasing competition in retail banking. So it combines financial and competition authorities as well as the central bank, and it aims to integrate a competition analysis directly into considerations for reform design, particularly as they're facing a concentrated banking market and they've identified the need to inject more competition. So a key tool in this context is the competition assessment. And competition assessment is a term of art. It comes from the OECD recommendation on competition assessment. And what this is a structured review of laws and regulations that helps identify whether certain provisions might unnecessarily restrict competition, and to assess whether those restrictions are necessary to achieve that, of course, legitimate public objective, or whether alternative, more pro-competitive alternatives might exist. So ex ante assessments, while regulations or laws are being drafted, help enable the prevention of disproportionate barriers to entry and expansion, while conducting these ex post on already existent regulations or laws helps ensure that frameworks remain proportionate and also that they remain relevant, particularly as markets and digitization continues to evolve. And allow me to mention that also competition enforcement complements this process. So I know that we talked a little bit about merger enforcement and how important merger enforcement might be including in times of crisis earlier. But equally important is competition enforcement, what we call conduct enforcement. And this means whether to stop collusion amongst market participants or abuses of dominance or monopolization by incumbents. So let me give you just a couple illustrative, very quick examples. In Korea, for example, prior to the 1997 Asian financial crisis, Korean law explicitly permitted certain government-approved cartels. So it was prioritizing short-term stability and collaboration or collusion between banks over competition. And a cartel is an agreement between competing firms to collude and fix prices, or to limit output, or to coordinate market behavior rather than compete. And ultimately, it was found that this combined weak enforcement, which also featured weak prudential oversight, reduced market discipline and actually encouraged excessive leverage and inefficient investment. And so it was found to have contributed to the structural fragilities that amplified the Asian financial crisis. So as a result, in the wake of the global financial crisis, and more recently, the Korean government has reaffirmed its commitment to strong competition enforcement. And indeed, it continues to underscore that competition enforcement can be complementary to financial stability. And let me just turn to a couple of very quick examples on abuse of dominance or monopolization. So abuse of dominance or monopolization occurs when a firm with substantial market power uses exclusionary conduct rather than competing on the merits. And this might be to maintain or strengthen its dominant position, and could include strategies such as, for example, foreclosing rivals or raising rivals' cost. And this is bread and butter for competition enforcers and the types of challenges that we bring. So, for example, in Kenya, the competition authority found that Safaricom had abused its dominance by imposing exclusive agent clauses, and separately by setting USSD prices that raised rivals' costs and reinforced network effects. And this had impacts on the mobile payment services. So enforcement action and advocacy by the competition authority, also combined by multiple initiatives by the Central Bank of Kenya, including, for example, an interoperability reform, has reduced switching frictions and expanded effective competition. And we also have examples of enforcement, say, in the European Union, where very recently concerns related to Apple have come up. And here it related to the restriction of access to iPhones by competing wallet or mobile payment operators, which meant that only Apple Pay was available as a payment option on the iPhone. There was also concerns that for banks, access to Apple's ecosystem required confidential agreements and the acceptance of quite high kind of take it or leave it transaction costs, which ultimately affected consumers downstream as they were paying for it. So following competition enforcement by the European Commission, commitments have been adopted, and this includes opening access to rivals on the iPhone. And we do see an increase of choice for users here in Europe, thanks to that competition enforcement. So control over access and interoperability, generally, say in digital ecosystems, can entrench dominance, and coordination between competition and financial regulators is often essential to restore competitive conditions. So together, cooperation frameworks, systematic competition assessments, and effective enforcement can really help align stability and competition, ensuring that financial markets remain resilient, inclusive, and contestable. Next slide, please. So let me conclude just with a couple considerations to better align prudential and competition objectives. So first, calibrated capital requirements, activity, and licensing frameworks. Static rules that are designed for traditional banking models may entrench incumbents. So dynamic approaches such as scalable licensing, risk-based capital requirements, or digital-only licenses might better align requirements with risk profiles and business models. Second is credible exit mechanisms. Contestability, as mentioned before, requires credible entry and exit. So modern resolution tools reduce reliance on crisis mergers and ensure that inefficient institutions do not persist. Third is effective merger control. Relaxing merger enforcement risks long-term anti-competitive effects, and it also magnifies too big to fail dynamics. And finally, cooperation and systemic consideration of competition. So structured dialogue, joint initiatives, competition assessments, and the principle of competitive neutrality can help align objectives. Across some of the examples I discussed today, from Basel calibration to SOFIPO licensing in Mexico, or bail-ins or simplification, generally a single principle emerges. And this is that regulatory design can shape market structure. So if we strike the right balance, digital transformation can deliver innovation and inclusion alongside resilience and competitive dynamism. Thank you very much, and I'm really looking forward to our discussion.
Thank you so much, Beatrice. That was very, very interesting, learning lots of new things. Thank you so much for that discussion. You've really gone to the crux of what we've been debating about. But without any further ado, I'm just going to invite Robin to take us through to the next session of the program.
Thank you, Anthea, and thank you so much, Beatrice. That was really excellent overview of a topic that is quite complex in nature, but I think it is really at the heart of what our members are grappling with day to day. So really, really very relevant. And I think you set out very nicely in your presentation the tensions and the complementarities framework. And also really liked the point you made about capital calibration functioning both as a stability tool, but also as an entry cost. And I think that's one that will resonate a lot with members as well. And you had lots and lots of nice, rich and practical examples in the presentation as well, both good practices like the UK's strong and simple regime, but also some cautionary tales as well, such as the UBS Credit Suisse merger and potential long-run consequences there. So thanks for doing a fantastic job with the presentation. What I'd like to do now in the relatively short time that we do have remaining is just probe a little bit some of the areas that may perhaps be most relevant to AFI members and where there might actually be some slight distinctions between the developing country context and the advanced economy context as well. And the best way, of course, to do that would be to hear from our members directly. So I do encourage members to pose questions. You can raise your hand to do that live, which would be wonderful. But if you don't want to do that, you can also write your question in the chat and I'll look out for it. But since there's no questions right now from the members, I'll start off with one or two myself, if that's okay, Beatrice. And first of all, just coming to your overall framing of the relationship between competition and prudential policy. I like the way you set it out because the framing of balancing, it initially implies maybe that more of one is less of the other, that these are opposing forces, sort of like a seesaw analogy. But the way you've set it out, I think you made a strong case that these can be complementary goals, provided that effective policy frameworks are in place, provided that there's effective coordination amongst the different stakeholders as well. I just wanted to ask you, how would you really define success in achieving alignment between these two policy goals at the country level? And I'm guessing that there's no sort of universal formula that can be applied here. It's something that needs to be calibrated according to local context. But maybe you could give some advice for the national regulators in the room, just how they could go about thinking about that and working on that.
Thank you very much for the great question, Robin. So Yes, I'd start by emphasizing that certainly there is a complex relationship between prudential objectives and competition objectives, though they certainly can be complementary. And what we saw through, previous historical decades was that really empirical evidence was mixed. The kind of sweet spot, whether more concentration leads to less or more risk depending on the sample or the measure that we were looking at. What I can say is that empirical research today certainly reflects that overall, more competition, if not excessive, and that's hard to define, can be beneficial. So there's a U-shaped relationship. And there's so many different measures that we can look at as to how to measure competition empirically. But based on our discussion and also recent empirical evidence at the OECD Competition Committee that followed this recent report, we see that the best measure for individual jurisdictions and across jurisdictions really is market contestability. Because if we only focus on, say, structural measures such as the degree of concentration or a couple direct measures, say relative profit differences or otherwise, we might be missing the point, or we might be making the point slightly too complex to measure for all authorities. So really thinking through the presence of entry barriers and expansion barriers, and whether there is indeed that sense of competitive pressure seems to be the most practical solution to measuring competition, and thus targeting whether regulation might need to open a little bit more potential paths to entry, or whether there is sufficient competition and one doesn't necessarily need to tweak the framework. I think a key point is certainly that prudential regulation is invaluable, it's indispensable, and the advocacy here is certainly not toward deregulation. It's just very much a message of keep competition in mind, since regulation does indeed shape market structure and incentives and outcomes. And a way to keep it in mind is thinking through contestability and how regulation is impacting that ability to enter, that ability to scale, that ability to compete, and whether that competitive pressure translates to behaviors across the market. I hope I answered your question, Robin.
Absolutely. Thank you. Thank you so much for that, Beatrice. I'm going to ask one more, and then I see Clarence has a hand up, so I'll go to Clarence next. But just before that, one of the things I really like about the paper and the presentation is you've really brought it up to the present day in terms of addressing non-banks and fintechs, whereas a lot of the sort of classical academic literature on this topic is just around banking sector competition. And I think, the paper frames very well the sort of in-out dilemma, where if you bring fintechs and non-banks inside the regulatory perimeter, you may have a negative effect on competition, but leaving them outside as they grow, there could be adverse effects on financial stability. But maybe one of the differences with developing countries is that fintechs and non-banks are not only providing additional choice quality to already included consumers, they're often the only access point that many consumers have to the financial system. So with that in mind, do you have any advice to especially those developing country policymakers thinking about how to sequence this extension of the regulatory perimeter, but without negatively impacting this dynamism that's so crucial for bringing people into the system?
Thank you for that question, Robin. So I certainly would start by saying that this is not a binary choice. It shouldn't be viewed as in the regulatory perimeter, competition suffers. Out of the regulatory perimeter, competition thrives, but prudential safeguards are completely lessened. I think this is where really balancing can come in. And maybe examples, well, in where we see, say, in certain jurisdictions, very established banking markets, we have the concerns both from a competition and prudential perspective as to partnerships. And here's where scaled regimes come into play. But the same might be true outside of bank NBFI partnerships where, say, new non-bank providers are part of an ecosystem, say part of telecom provision or other services, and we might need to think about the different ecosystem effects, whether certain firms are systemically important, and thus maybe we shouldn't be thinking only about activity-based regulation, but entity-based regulation. But generally, I think that coming again at it with a risk-based approach, where we can think of services posing different risks, whether it's, say, credit versus term deposits versus demand deposits. Maybe if the goal is more competition or financial inclusion, it can be targeted in a certain way that it enables that entry and provide scale pathways for these new entrants. And let me just add, by the way, I forgot to mention this, that the SOFIPO licensing regime in Mexico was actually created with financial inclusion in mind. It wasn't initially created with the goal of competition, but it resulted in competition. So here's how we see how different policy objectives can really complement each other.
Thank you. That's a wonderful example that I'm sure members would like to study more. We have a question in the chat, but let me just check, Clarence, if you're still there. Would you like to ask your question?
Yeah, thank you
Go
very
ahead.
much for the opportunity to be part of this wonderful program, and thank you for a wonderful presentation. A few things came to mind that I want us to reflect on. Maybe you can provide us some kind of guidance. We usually try to distinguish between competition in the market and competition for the market. In the emerging digital space, where economists have become some sort of integration of platforms across which people transact, and the payment system being the glue that is binding all of them together. In developing countries, we have situations where the infrastructure that should have been provided by the public sector is not there. A private entity comes in, invests hugely, and gets a first mover advantage because they've laid down the rails. You often hear complaints from people that this entity is taking over the market and the regulator has to do something. In the absence of that entity, it also becomes a challenge. How does one navigate this tight lane to be able to satisfy the stakeholders? Also, the nature of some of the ecosystem creates some dependencies that still benefit the ecosystem, have become unavoidable. And some of these situations, how does one act to avoid supporting an entity to become extremely dominant, such that it begins to trample on the business interests, the rights of all the other players that are not of the same size as this entity? Thank you.
Thank you very much for that great question, Clarence. And I'll note that there is a paper from June from the OECD Competition Division that addresses specifically competition in mobile payments. And these are very much the types of issues that we focus on and attempt to discuss. So a couple quick responses come to mind. First is, to the extent that jurisdiction can potentially provide public infrastructure because it determines that competition is not working in the market, then I think a couple really good examples that I call success stories come from the PIX infrastructure instituted by the Central Bank of Brazil, as well as the UPI infrastructure instituted by the Reserve Bank of India, which allow that interoperability at the retail payment rail level that allows for entry and competition on a level playing field. But where those infrastructures are not present, and where we are, seeing these first mover advantages, market tipping, and also the ecosystem effects that might come from control over digital infrastructures or control over telecom infrastructures. And as these markets do have high barriers to entry and can be deeply interlinked then with the provision of payment services, I think one key consideration that comes to mind is certainly the importance of a very present and keen competition authority, as the competition authority can certainly look into conduct, whether it is, say, as in the example of Kenya and its competition authority, whether there's exclusive agent agreements which are preventing competition in mobile payment services, whether certain prices on USSD on the telecom side might be influencing the prices and access to payments, whether certain platform providers are generally raising rivals' cost or impeding access. So here is where competition enforcement really can open up access and attempt to avoid those risks of self-preferencing, particularly where markets are adjacent and complementary, and dominance in one can lead to dominance in another. So I would advocate for very keen competition enforcement. And I think here is another area where the competition enforcer also very much benefits from the knowledge of prudential supervisors and central bankers, and might benefit from getting these risks flagged to it for potential investigations, and also cooperation on remedy design, whether it's access or interpretability measures or otherwise, that might also be complemented with pro-competitive regulations, bringing benefits more swiftly. I hope I'm answering your question.
Thanks,
Yes,
Beatrice.
yes, you have. You have. I like the context bits of it, and the fact that one has to be keen on the issues that are playing out in the market to be able to identify and address them in time is good. I'll be happy to check on the paper and see what is in there. Thank you very much for your direction.
Thanks, Clarence, for the great question as well. We're slightly over time, but there's a question in the chat, so I do want to read that one out and just give Beatrice opportunity to respond to that before we close. So the question is from Alfredo, asking what tools and technologies can supervisors adopt to effectively oversee a growing number of digital financial services providers? And another question, how can proportional regulation be applied without creating systemic risks? So Beatrice, if you have any response to either or both of those questions.
Thank you for the great questions. So in relation to the tools and technology, and please do speak up if I'm not answering your question, because what comes to mind is this idea of this increasing digitization of financial services, and that not only are supervisors and regulators faced with new entrants and how to apply the prudential perimeter to them, but also the fact that across financial services, we're relying more deeply on technology. So now there's risks of banks or digital-only providers relying on cloud computing from another service, and how that might pose systemic risks, which certainly brings further challenges. I know that, and I hope this is not too far off from your question, but I know that there's initiatives in, say, the EU, where indeed banks and non-bank financial entities are having to report what their technological systemic risks are, so that, say, if there's a cloud computing interruption, this is something that supervisors can be aware of and attempt to ensure that there's less dependency and concentration on only a handful of cloud providers. But generally, as to how to oversee digital financial service providers, as you know, depending on the type, there's multiple concerns, even when it comes to say credit, which across most jurisdictions tends to not require licensing. We also see risks of, say, buy now, pay later, leading to indebtedness. So I would say that the key tools here are talking to other regulators and taking regulators or authorities and taking a horizontal approach. Not only competition authorities, as there are certainly competition effects through the financial services segment, but also to say consumer protection authorities who might be able to help regulators think through of other risks such as indebtedness. And then I believe that there was a second question about how can proportionality ensure systemic resilience, I believe.
Yes. How can proportionality be introduced without adding to systemic risk was the question.
Yes. Thank you very much, Robin. So I think I'd say that the key takeaway we have from previous financial crises is that most of these crises followed waves of deregulation. So if you note, the way we're talking about adapting regulation today is certainly very cautious, or at least I hope it comes across as cautious, as the purpose here shouldn't be deregulation, because that might indeed increase financial instability and might shorten the length to the next crisis. But in balancing carefully in light of the current market dynamics in your jurisdiction, if you see that competition is not working well, then you might say consider scaled licensing pathways rather than deregulating. How can you adapt that regulation to the risk profile and complexity of different institutions to allow entry and scale? So it's not about deregulation, it's about proportionality, I suppose. I hope that answers the questions.
Thank you so much. I think that's a wonderful message to finish on as well, because we are unfortunately out of time. But this was a really rich discussion. I think one of the messages that really came across was the criticality of effective communication and interregulator coordination. And with that in mind, it's great that we had two of our working groups in this webinar, our Digital Financial Services group and also our Global Standard Proportionality group. And I think this topic would actually be quite fertile ground for those two groups, maybe to conceptualize a bit more work and peer learning in this area. And we'd certainly love to keep in touch with you, Beatrice, as we go on that topic. But for now, let's thank Beatrice again for her wonderful presentation. And thanks, members, for your active engagement as well. And I'll pass to Giaz, I think it is, for the closing remarks.
Thank you. Thank you so much, Robin. I'll be very quick as I try to summarize what is a very complex discussion. I request members to please take a moment to provide evaluation of the discussion today. Your feedback is really very important for us members to improve the quality of deliberations that we have on competition and related topics. Take a few seconds to provide. I've also shared a link in the chat box, so you can copy the link or you can scan the QR code to provide your evaluation. As you do that, let me thank Beatrice. Beatrice, this was a very complex and niche topic, and I am really truly inspired by the way you articulated this topic in such a clear manner. Thank you so much for providing practical examples and from various geographies, both from developed countries and developing countries. And one thing that clearly stood out for me was the example that you gave from Mexico, which kind of provided the complementarity between financial inclusion and competition, which is also something that our members are clearly looking at. And this is one such very good examples. I also really appreciated the details that you provided around the key tensions and complementarities when it comes to prudential regulation and competition from the banking sector. And many of the topics that you did indicate resonate with our members, especially with the role of big techs and large fintechs in the broader digital ecosystems. and their potential in advancing financial inclusion, but also implication on competition and related regulatory interventions. I really like two of your quotes. First is regulatory design can shape market structure, and regulatory complexity itself can act as a barrier to entry. Let that be two key messages that we could take from today's discussion, and link them to the need for balancing prudential regulation and competition. Thank you again, Beatrice, for your time, and thank you, Robin and Anthea, for facilitating this session in such an expert manner. Dear colleagues, I request you to please give them a round of virtual applause, and I'm sure you would have provided your evaluation by now. Thank you so much. Have a good rest of the day and rest of the evening. Let's keep these conversations going. Thank you.
Thank you.
Thank you so much, everyone. We're going to end the call here. Please feel free to share any questions, even via email, and we'll have the discussion afterwards. You can share this with Beatrice. Thank you so much. We're going to end the call.
Thank you.
Thank you.